Welcome to a thoughtful conversation regarding the stock market's current state and the foreseeable concerns. In recent testimony before the House of Financial Services Committee, Federal Reserve Chairman Jerome Powell mentioned the prospect of raising interest rates to combat inflation, which sent the stock market down. The Bear Traps Report founder and New York Times best-selling author Larry McDonald joins the discussion to share his viewpoint on the state of the economy and the likelihood of a stock market crash within the next 60 days. According to Larry, there are serious flaws in the system that might cause the market to decline by 10, 20, or even 30%. These flaws range from the effects of rising mortgage rates to the capital flight of middle-class households. How can investors safeguard themselves, and what does this entail for the employment market? Join us as we explore the answers to these important issues and potential tactics for negotiating the choppy waters ahead. But first, make sure you've subscribed to our channel before we get further into this video. Also, please rate us with a thumbs up. Hit the notify button while you're at it to receive updates on our uploads. Now that has been said, let's begin the video. Recently, the House Financial Services Committee heard testimony from Federal Reserve Chairman Jerome Powell. The stock market fell as a result of his remarks regarding the prospect of raising interest rates to combat inflation. According to Powell, the pace of rate hikes would quicken if the economic data suggested that tightening policy was necessary sooner rather than later. Powell's speech was reviewed by New York Times best-selling author and founder of the Bear Traps Report, Larry McDonald. McDonald thinks Powell and the Federal Reserve are lagging behind the inflation that began to increase in 2021 as a result of the quantitative easing program. He issues a warning that one of the biggest possibilities of a stock market meltdown during the next 60 days is indicated by the systematic risk indicators. Statement number 1. McDonald adds that a major drop in consumer expenditure is being brought on by middle-class families withdrawing their wealth. The economy gains 1%, but middle-class families lose $50 billion. Auto loan rates are currently close to 14%, with roughly 20% of loans having monthly payments or more than $1,000. The middle class is significantly impacted while the wealthiest profit from higher interest rates and extra savings. Statement number 2. Next, the impact of increased mortgage rates is discussed. The 30-year fixed rate has increased to 6.79%, which makes consumers worry about their financial future. Johnson disagrees with Larry McDonald's analysis and thinks a robust economy will avert a recession. McDonald, based on his layman science, continues to warn of a possible crash within the next 60 days. McDonald contends that many investors have kept money in the market for extended periods without seeing meaningful returns. Investors are beginning to wonder about the psychology of the market since even the most crowded investments, like the idiotic FANG stocks, have failed to gain any traction. On the other hand, a risk-free money market fund or one-year treasury yields $510,000 in interest on $10 million. This represents a huge decrease from the $70,000 it was 1 year ago. According to McDonald, investors should exercise caution in the upcoming months and keep a close eye on the market. In plainer terms, Jerome queries Larry as to whether he thinks investors will sell their stocks to purchase bonds now that they are aware of their options. The typical investor wants to make money, and with the current fixed income rate, they may purchase bonds and earn a 5% return on a $500,000 investment. The stock market is becoming a less appealing choice. But things could alter if there is a recession. There is a risk-free model that was infamously employed by a stock market millionaire before 2007, when a spike in a risk-free rate caused stocks to decline. The 2-year treasury is currently 100 basis points more expensive than the 10-year, which is a dangerous position. Statement number 3. Regional banks have also been underperformed over the past year, a solid sign of market changes. This implies that there are serious systematic flaws as a result of awful things happening in commercial real estate and auto loans. As a result, During the course of the following 60 days, the market may decline by 10, 20, or even 30%. How this impacts the job market is the question. According to the jobs report, 200,000 new jobs in the private sector are anticipated to be created, and the unemployment rate is forecast to stay at 3.4%. Even with rapid job creation, history demonstrates that a market catastrophe is still conceivable. Before the market collapse in 2000, employment levels were at their highest. Hence, even though there are plenty of jobs right now, this does not guarantee that the market will be steady. They talked about how the January job data might serve as an illustration of this scenario during a teleconference with more than 650 investors from around the world. The markets put on a stunning performance in February, providing a soft landing that many were anxiously awaiting. Going back over the last few decades, there has been a discernible pattern of seasonal adjustments in January, followed by an equally seasonal uptick in February. The performance in February and March is usually more modest after this dramatic increase. Thankfully, this slowdown may benefit the job market by preventing an uncontrollable rise in unemployment. The Federal Reserve may now have some much-needed breathing room to change interest rates as necessary as a result. Additionally, this change can support emerging market stocks, gold, and mining companies, all of which stand to gain from a future Fed rate cut. Financial analyst Stephanie Palmboy has been foreseeing this development for some time. According to Larry's study and his discussions with several financial organizations, it seems that gold may be a trustworthy hedge in these unpredictable times. As a result, people wishing to protect their investments from possible market volatility may find that investing in gold miners on the stock market is a prudent choice. Many are seeking other places to shelter within the stock market though, if the forecasts of a stock market crash within 60 days are accurate. Following the dot-com crash, European global equities were the most popular investment from 2001 to 2003, when the trading floor was still open. It is thought that here is where the allocation should be, and it may be the best bet. The global equities MSCI ex-US is breaking a multi-year down channel, and for the first time, you're seeing exceptional outperformance from global equities MSCI ex-US. Whether a US stock sell-off will lead to a European sell-off is uncertain, but if the American stock market crashes, it is unlikely that the rest of the world won't do the same. The concern is heightened by the fact that Chinese stocks dominate the MSCI index. Data on inflation or additional economic indicators that fall short of expectations could have caused this stock market drop. The SPY earnings are anticipated to reach $226, but the outcome is still uncertain. We appreciate you viewing our intelligent conversation regarding the stock market's current situation and the potential threats that lie ahead. We hope Larry McDonald, the publisher of the Bear Traps Report and a New York Times best-selling book, provided you with some insightful advice. Given the likelihood that the stock market may crash over the next 60 days, it's critical to be ready and consider several coping mechanisms. As always, don't forget to subscribe to our channel, give us a thumbs up, and hit that notification bell to stay updated on our uploads. Thank you for joining us, and we'll see you in our next video.